Folks, all I have to say today is certificate yet. A certificate yet. Wells Fargo chose to reverse or moonwalk their decision to close down all personal lines of credit. And what we want to do is we want to get into that right now. All right, this is what we're going to be talking about. We're going to be talking about why did they choose to reverse that decision. We want to talk about how the consumer advocates oppose credit closures. Oh man, very important. And then number three, we want to show you how revolving credit lines affect the credit score, how the revolving credit lines reflect the credit score. And that's what we want to show you today, okay? So last month, CNBC first reported that Wells Fargo was shutting down all personal lines of credit and would no longer offer the service to customers. Weeks after facing public scrutiny from customers and consumer advocates, the bank announced, hey, you know what? We found a solution. A reversal of its decision. And I quote, based on feedback from our customers, thank you if you provided feedback, we are adjusting our approach. John Rasmussen, an executive vice president who oversees Wells Fargo's personal lending business, wrote to active customers in an email seen by Bloomberg. Okay, the outlet reported this on Wednesday. The terms of your account are not changing, he goes on further to say. So why did Wells Fargo reverse its decision? Wells Fargo didn't immediately respond to CNET's request for comment. Previously, a Wells Fargo spokesperson said the bank's decision to close personal lines of credit came down to just simplifying its product offerings in order to better meet the borrowing needs of our customers through credit card and personal loan products. The bank has had a tumultuous few years, to say the least, of federal investigation. In late 2017, the Federal Reserve actually imposed a cap on the bank's assets, essentially preventing it from growing its balance sheet. The move came after an investigation revealed that Wells Fargo employees had opened checking and savings accounts without customers' knowledge. Now, account holders were also forced to pay millions in credit and mortgage fees. In February 2020, the bank agreed to pay a $3 billion settlement to the U.S. Securities and Exchange Commission and the Justice Department. And the asset cap remains active until the compliance issues tied to the fake account scandal are completely addressed. Now, amid this situation that's happened starting in 2020 and due to limitations set by the Federal Reserve, the bank halted new home equity lines of credit and announced it would no longer provide auto loans to most independent car dealerships. And this is what CNBC reported. In February of this year, the Federal Reserve approved Wells Fargo's proposal to overhaul internal risk management and governance practices, moving the bank one step closer to removing Federal Reserve sanctions. Now, when asked whether the asset cap was a factor in no longer offering lines of credit, a Wells Fargo representative said the two issues were not related. Now, we want to go to the next issue then. Why did consumer advocates oppose credit account closures? In its previous statement announcing account closures, Wells Fargo acknowledged the inconvenience, especially when customer credit may be impacted, quote unquote. Consumer advocates took issue with the move and its potential impact on customers' financial stability. And I quote, not a single at Wells Fargo customer should see their credit score suffer just because their bank is restructuring after years of scams and incompetence. This is what Senator Elizabeth Warren tweeted on July 8th. Okay, sending out a warning notice simply isn't good enough. Wells Fargo needs to make this right. That's why. So how do revolving credit lines affect your credit score? Listen, closing a credit account can hurt your credit scores by affecting the length of your credit history, especially if the account has been open for several years. It can also affect your credit utilization ratio, the amount of debt that you owe compared with your total credit limit. The lower your debt to credit ratio, the better your credit score. For example, let's say you have 3 credit accounts, all right? And let's go ahead and break this down. Say you got account A at $5,000, account B at $2,000, account C at $3,000, and they each have a $10,000 credit limit. The total debt above $10,000, all right, divided into the total credit limit, $30,000, equals a utilization ratio of 33%, as you can see, right? Now let's assume that account C is closed by the bank. Now when this occurs, your total credit limit automatically decreases to $20,000 and your credit utilization ratio climbs to 50%. While there isn't much you can do about your bank's decision to shutter your account or not, you can safeguard other items on your credit reports. According to TransUnion, one of the 3 major U.S. credit reporting agencies, the best way to minimize credit damage is to keep older accounts open and active to ensure that your credit length is accurately represented. It's also a good idea to charge no more than 35% of your total limit on each credit account. So keep that in mind, and you know we utilize our credit for our advantage, mainly to pay down the mortgages and any loan that's amortized so that you can build wealth instead of building debt. Folks, thank you so much for watching. We will absolutely see you soon. And we actually have another example of someone who needs help and is on the right track and is using the velocity banking method for their advantage. So let's go ahead and check that out on the next video. God bless, and you have a good one.